This morning, Iran moved to enforce a total blockade of the Strait of Hormuz, effectively closing the route to all global shipping. This map shows the physical reality of the disruption. By shutting down this single choke point, over 1 billion barrels of oil have been removed from the global market. The International Energy Agency has already quantified the scale of this event. They cite it as the largest supply disruption in the recorded history of the oil market. Mathematically, a physical supply shock of this magnitude should trigger an immediate and significant reaction across global financial markets. Yet the data tells a different story. This chart shows that despite the historic blockade, oil prices rose by only 2%. This 2% figure is an anomaly. It represents a disconnect between the physical shortage of oil and the price the market is currently willing to pay. This surface-level stability prevents the world from seeing the actual risk. It is a temporary pause in a system nearing collapse. Oil is currently trading around $95 because wealthy nations have spent the past several months using specific tools to mask the true impact of the shock. Part of this cover-up involves the physical movement of supply. This map shows global oil tankers forced into massive detours around Africa. Simultaneously, elevated prices suppress consumer demand to keep the market from overheating. These measures, rerouting ships and suppressing demand, do not resolve the supply gap. They only delay the moment we feel the consequences. That delay has a limit. The IEA warns that these temporary protective shields are expected to run out by mid-July. Once that window closes, the global economy will have no remaining mechanisms to hide the physical shortage of oil. The final layer of defense is the United States' own emergency oil supply, a stockpile that is being drained at an unsustainable rate. To maintain the appearance of market stability, the U.S. has used 66 million barrels of these reserves in just a few months. This chart shows the result of that drawdown. Total volume has plummeted to 349 million barrels, the lowest level in decades. Despite this depletion, there is currently no plan to rebuild these emergency reserves before 2028. A reserve intended to protect the country against domestic disaster is being used to temporarily manage a crisis happening thousands of kilometers away. The true cost of this crisis is moving beyond energy. It is now spreading into the global food supply chain. Roughly 1/3 of the world's seaborne chemical fertilizers originate in the Gulf and must pass through the Strait of Hormuz. With that route blocked, fertilizer prices have already jumped by 30%. On this chart, we see how those higher input costs lead directly to lower crop yields. This is a delayed contagion. A naval blockade in 1 month becomes a crop failure months later, as farmers struggle to afford the nutrients required. The World Food Program projects that this disruption will expose 45 million more people to acute hunger and starvation. Aid agencies describe a situation so severe they are now forced to take from the hungry to feed the starving. These shortages create a ripple effect. As food exports tighten and global prices surge, middle-class neighborhoods are seeing the impact of suddenly bare grocery shelves. The artificial calm in financial markets is being paid for locally, where families are facing a sudden new reality of food insecurity. Today's story is the illusion of calm. The reality of the crisis is already here. Follow us for your future.